Howdy, Jacob here. Today we're going to do a more in-depth analysis on the Cigna group. Just want to remind everybody that everything I say will be in my opinion. Do what you want with it. This is an in-depth analysis, but it's not end-all be-all. If you were to want to look into this company more, if it still looked like a screaming, or if it looked like a good deal, like you could get a good return on it, you'd still want to look at the competitors, look at more years of history and get a better idea to become more confident, really know everything about the business, everything about their competitors, why they have, an advantage or not. And so this is just doing a deeper dive really into the numbers, but it's not necessarily doing a deeper dive into the story and backing out, why you would want to or not want to invest in this business, why they have moats, not moats, have an advantage, no advantage. And so I want to remind everybody about the business. So let's look at their income statement, balance sheet, free cash flow statement, and then we'll look at some of the notes that I took from most recent 6 quarterly reports, most recent 10Q, and then most recent 10K. So market cap of $94 billion, $117 billion enterprise value, a little bit of net debt there. Revenue growth is very impressive. Earned premiums also up, very impressive, with high increase in earnings per share. Been paying a dividend, but increased it pretty substantially between 2020 and 2021. Balance sheet shows almost just under $9 billion in cash-like products, with $2.7 billion short-term debt and $28 billion long-term debt. Cash flow statement has fantastic production of free cash flow. CapEx is nothing in comparison to cash from operations. They produce a hefty amount of cash flow, and their use of cash is a dividend yield that pays out 1.6. I think that's right in line with very close to what the S&P is, and that's going to be about 1.5 billion in relation to their, let's say, 8 billion free cash flow. So not a lot. A lot of it is going to share repurchases, and then a good amount to reinvestments and acquisitions and stuff. So let's look at some of the notes that I took from reading quarterly reports, 10Q, 10K. So the CEO comments are very short and vague in the quarterly reports. This is going to be the smallest paragraph, maybe a sentence, 2, 3 max. And so you're not really getting a lot from what the CEO says. I mean, again, nothing is an end all be all, but I do prefer, a CEO that goes in depth into the review, or a CFO that goes in depth into the numbers and explains what they were, why they beat, why they didn't, why, they need to perform better, what they're working on. And so I didn't really like that as much. I did enjoy, however, the separation of businesses within. I appreciate the year-end outlook, but I wish it were farther out. But year end is pretty standard. They have cash from operations in most highlights, but they do not show the cash flow statement. Again, it's not advisory shares, so they do put out the 10Q as well, maybe slightly delayed from the quarterly report, and so you can look at the statement of cash flows. But from all that, I just wanted to say I like they separate out the business, because you can see the margins of their pharmacy versus their premiums. And so I do like that. That's similar to, an Alibaba, where they separate out most of their businesses. So you can really see what margins each business is producing. And I do like that. On the income statement, they separate out expenses the same as revenue. Again, is nice because we can see the operating profit margin for each business. RX has an operating margin of 2.6%, representing 70% of revenue. Premiums are 21.9% margined, make up 23% of revenue. And then all other fees, other revenues, investments make up 7% of revenue, and they're negative margins. Growth of RX is 7% year over year. Premiums is 11% year over year. And other is 15% year over year. So just on the last year, you see good growth in premiums of 11%, other 15%, but other 15% makes up the least amount of revenue, but is the worst performing from a margin bottom line perspective. Their 10 largest RX chains represent roughly 60% of total number of stores and network. to me, I'm not concerned with any supplier going out. I mean, they supply their drugs to very well known and established businesses, so I'm not concerned about that. It's not like in mode where they had one supplier and yeah, their balance sheet for that supplier was good, but it's just you're a little skeptical about it. Here, I'm not worried about anything going under from the supplier or who they're who they supplied their drugs to. They have 30.9 billion in debt. I didn't go into more about it, but you have 2.8 billion in short-term debt, 28 billion long-term debt in relation to their free cash flow. It is a good amount. So I will say I'll probably put more of their free cash flow to debt than what they've done historically. Historically, they've used about 11%, negative 11% acquisitions. So that's 11% selling off of acquisitions, 10% debt pay down, 18% to their dividend, and 71% to share repurchases. They health insurance. This is just a statement. Health insurance is different than property and casualty because if you look at every single year for the last 10 years, their premiums, their revenue from premiums was always greater than their cost from benefits and claims. Whereas something like property and casualty, if you were, dealing with insurance for homes in Florida, it's going to be wildly cyclical. And so here, we don't see that, which makes me feel a little bit more comfortable. However, I did look at their historical P and price free cash flow, and it didn't make a whole lot of sense to me. It's averaging in the single digits, and I don't really understand why with their growth, with their margins, with their consistency. But you do have to take history into consideration. And so, one more note, 19.8 billion medical customers in 2023, up nearly 16% from the last 2 years. So 2 years ago to today, up 16%. Pretty solid. So here I have their share repurchases in thousands. So you have 6.1 million in Q1 at a price of 230. I mean, they just buy back a lot of shares. Doesn't really matter the price. So really you're going to get the return of the business, which for a good business is fine. For companies that are more cyclical and less, have higher variability in stock price and performance, you want them to be buying back at extraordinarily cheap prices. But to really average out and get the return of the business for a company that's growing as much as Cigna, I think might be decent. So for me, I lessened the margins again because I do think that their RX growth is going to be greater than their premiums growth, and their other growth as well is going to be greater. And so those are the lower margin businesses. So I lessen the margin slightly. 3% share repurchases for them right now represents roughly, $3 billion. And that is less than 50% of their free cash flow. I'm saying, 20% to dividends, keeping that roughly the same. And then I will be saying about 20 to 30% goes to debt reduction. So with those assumptions and using the historical PE as a figure to use, I get a price that needs to fall 38% from where it's at today. I mean, to me, it's just better understanding this and whether I think that's true or not. Maybe it's been historically 10 and, they don't deserve that. So the future could look a lot brighter. I know Cigna is very similar to an Elevance Health, like Anthem, United Health. I think they're pretty similar. And their United Health's PE and price free cash flow historically have been 20 plus. And so it's really just understanding this figure. I think I'm pretty comfortable with all the rest. And so if I do a deeper dive here, or look even farther before I invest in this company, I will become more confident in this PE price free cash flow, and I'll be more confident in how they differ from Elevance Health, United Healthcare, CVS. Why would I choose Cigna over them? I do hope you enjoyed this in-depth analysis, and I hope you have a fantastic rest of your day. Thank you.